In 2026, the idea that stocks only go up, that every dip gets bought, is close to consensus in the world's largest market. The most complete counterexample in the modern record is Japan, December 1989. This is that archive. This is an archive of Japan's 1980s asset bubble and its aftermath. Documented market data only. Not a forecast, not investment advice. Chapter 1. The Miracle. By the late 1980s, Japan's post-war growth had hardened into a belief. Tokyo was the future. After the Plaza Accord of 1985 sent the yen surging, the Bank of Japan cut rates to 2.5% to cushion exporters. Cheap money met national confidence. Stocks and land rose together, each used as collateral for the other. By 1989, Japan was approximately 45% of world stock market capitalization. The United States was around 30%. The grounds of the Imperial Palace in Tokyo were notionally valued at more than all the real estate in California. Golf club memberships traded like securities. Chapter 2, December 29, 1989. On the final trading day of the decade, the Nikkei closed at 38,916, its all-time high. The market traded at roughly 60 times earnings. The valuation was rationalized: cross-shareholdings, land backing, Japanese exceptionalism. Every dip in the 1980s had been bought. The lesson investors had learned was that selling was the mistake. Chapter 3. The Turn. A new Bank of Japan governor, Yasushi Mieno, took office in December 1989 and began deliberately pricking the bubble. Rates rose from 2.5% to 6% in 8 months. Lending against land was restricted in 1990. The Nikkei fell 39% in 1990 alone. Property followed with a lag, then fell for over a decade. Commercial land in the major cities eventually lost more than 70%. The collateral chains that built the boom unwound in reverse. Chapter 4. The Lost Decades. Banks carried unrecognized losses for years. The zombie bank era. Deflation set in. The Bank of Japan pioneered zero interest rates in 1999 and quantitative easing in 2001. The playbook Western central banks ran after 2008. The Nikkei's trough came in 2009, 7,054, 82% below the 1989 close. 20 years after the peak. Chapter 5, 34 years. On February 22, 2024, the Nikkei finally closed above its 1989 peak. 34 years and 2 months. In nominal terms, adjusted for inflation, it took longer still, softened only partly by dividends. The documented lesson is precise. Buying the euphoric peak of even a great economy meant a generation underwater. Japan remained rich, innovative, and stable throughout. The entry price did the damage. Chapter 6. The Pattern. The sequence in the record. Sustained success hardens into the belief prices cannot fall. Policy fuel meets national narrative. Deliberate tightening pricks it. The unwind runs for decades, not quarters. This archive does not predict that any current market repeats Japan. It documents what the only modern precedent of this scale actually looked like. The archive stays open. This is what the historical record shows.